Chamath, you've built an extraordinary franchise in special purpose acquisition companies. 6 SPACs, billions of dollars raised so far. Tell me, from your perspective, is there a limit? Is there a limit to what you can do with SPACs? Is there a limit to the size of the SPAC revolution in terms of available capital or quality of targets?
I think what's happening in SPACs is really about the dismantling of the traditional capital markets with respect to fundraising. So the equity capital markets, really had one go-to move, which was the IPO. And then obviously there was follow-on financings and all of that other stuff, but the traditional S1 driven IPO process. And what you picked was a brand that you trusted to be your on-ramp into the public markets. You pick Goldman, you pick Morgan Stanley, you pick JP Morgan, Credit Suisse, Barclays, et cetera. I think in 2021 and going forward, you're still picking brands, but that choice has become more atomized. And instead, you'll pick the IPO 2.0 platform that myself and Ian Osborne created. You'll pick, the reInvent platform that Reid Hoffman and Mark Pincus has stood up. You'll pick, the SPAC platform that Alec Gores has created. And there's many different versions of this. But that is the exact same decision that used to happen 25 years ago when you used to pick a banker. Except now you're picking an individual level partner. And so I think that SPACs are very much here to stay. Back in the, using the language of inequality, it evens the playing field. It democratizes access to high growth companies. How? Because it allows retail and it allows long tail institutional investors, folks that may not have necessarily been tier 1 hedge funds. Now they can also play. They may get allocation in the original SPAC IPO. They can go buy in the market as soon as it goes public. They can participate in the pipe. They can buy after a deal is announced. So many opportunities versus one allocation in a book building process that a traditional S1 process was all about.
What's the biggest SPAC you can see yourself raising?
Having a bigger size doesn't necessarily help. In fact, what's more useful is to actually have a reasonable size because you can upsize a deal with a pipe and instead focus on sectors and themes. And the reason is because, again, going back to brands, entrepreneurs want to partner with people that deeply understand your business. And so it's much more likely that if you had 2 or 3 SPACs, all of the same size, except with sector focuses, you could find different independent directors that were subject matter experts. That'll make the companies better. It'll make the diligence process more useful. The decisions are higher quality. And so I think that's where the world should go. But I'll tell you, putting a $400 million SPAC to work is meaningfully easier than a $1 billion SPAC. And I've done both, but the former is much more flexible than the latter.
You describe finance often as a game rigged in favor of insiders at the expense of outsiders, especially the retail investor, the little guy, if you will. But I would make the following observations, and others have as well, about SPACs. The sponsor gets a 20% promote. Wall Street banks get paid underwriting fees twice. Hedge funds get big share allocations and then cash in the warrants to make a risk-free return. And finally, giant investors like Fidelity, BlackRock, Neuberger Berman, and well-connected billionaires like yourself get to participate in pipe transactions at $10 a share, right? The same price as the retail investor, but with total information. How is that not a giveaway to insiders at the expense of outsiders?
Yeah, I think this is a really good point you're making. So let me break down a few of these points. Look, the first is that if you can generate superior returns, you should be allowed to compensate and participate yourself in that. When I used to manage institutional money, again, all of this capital is my own, but when I used to manage institutional capital in early stage investing, I charged a 30% carry. No hurdle, no nothing. And people were willing to bet that I could generate returns, and I have, 30+% returns over the last decade, that justified a 30% carry. Similarly here on the deals that I do, I take a 20% carry. And I think that I can find targets and find opportunities that will make that more than reasonable in the final analysis. And I think that if you look at the returns we've generated for shareholders, it's been nothing short of incredible, inclusive of the carry that I've taken. That being said, I've always thought it was important as well to do two things. Number one, Eric, is to put a lot of my own money on the line so that there was never a question of why I was in this. And I was in this to make sure that I could find great companies that I thought, again, fixed inequality or climate change. But then second, to accelerate those things with our capital and to make sure that I could explain it to people, including normal folks and retail investors. And I do that by saying, listen, just so you know where I'm coming from, I'm going to put in more money than any of you. And you should take that as a serious signal that I think that this is important and I take it very seriously. The second is that it allows me ball control. And then having ball control allows us to basically slowly even the playing field. Now, what do I mean by that? And this is to the second point that you brought up. I think that there is a lot of work that we can do to make sure that retail, A, has more allocation of the IPOs. Right now, we have a pretty decent allocation, but it's small. And the reason is that the technology that we use to allocate shares in IPOs is brittle. And I've been working with a partner. I don't have much to say beyond it's an intention right now, but I'm working with a partner and with Credit Suisse, our banker, to expose more of our initial IPO allocations to retail. The second is that we are going to start a process to try to educate the regulators so that they can expand how they think about what an accredited investor should be. The reason why we cannot give access to the pipes and some of these other mechanisms to retail is because of very strict regulatory definitions that we live by about who is a quib, who is an accredited investor, and those things are changing, but they're changing slowly. My perspective is that right now, the way we define it is too broken. So I think that there's work that I can do, and hopefully people will listen to those arguments and expand the rules, and that way more people will be allowed to buy pipes and these other things. But I want to be really clear. That is where we would like to move the ball so that everybody can be in an open, even playing field, bid for the IPOs, bid for the pipes, participate with complete, transparent information.
Chamath, you're an experienced investor, you're an experienced manager, and you can argue persuasively for the 20% promote or carry, if you prefer, that you earn in a SPAC transaction. There are people raising SPACs who have no experience as investors, no experience running companies. Is that movie going to end well?
The good news is humans are adaptive, and I think the answer is yes, we will be okay. Will there be a bunch of bumps along the way? I think so too. And so, yeah, we have a real responsibility to educate and teach people. But again, we need brands to do that because, nobody's going to listen to Buffett. Buffett doesn't have the energy to say what he said 30 and 40 years ago in 2021. And that's okay. He's earned the right to basically chill out and be the GOAT. But there has to be other folks that take that mantle and, take the baton and do it as well to this younger generation in language they understand. And look, to your point, that's why people say, like, who is this guy? Well, who I am is a byproduct of my generation and my media culture, which is faceted, not always great facets, but multifaceted. And so you have to speak in the language of the times in order to get your point across.